A multibagger is an investment that returns 3, 5, or even 10 times your initial capital. Finding one might look like a stroke of luck, or the result of insider information, but the historical data points to a more systematic reality. Many of the most successful long-term compounders share a specific financial profile built on 4 distinct pillars: earnings growth, capital efficiency, cash flow, and governance. This methodology is built on the work of investors like Peter Lynch, who looked for moderately fast growers with niche positions and no debt, often in industries that the rest of the market chose to ignore. Over the next few minutes, we're going to build a custom stock screener designed to filter thousands of listed companies down to a highly targeted elite shortlist. Open your preferred financial screening tool and prepare to input the specific metrics we'll discuss. While market sentiment often shifts on emotion, this 4-pillar framework isolates the financial indicators that have historically correlated with sustained capital appreciation. We'll start with our baseline for capital efficiency. In your screener, enter a requirement for a return on capital employed, or ROCE, of greater than 20% over the last 3 consecutive years. ROCE measures the return a business generates on all the debt and equity it utilizes, providing a clearer picture of efficiency than simple profit margins. This filter typically removes 80% of listed companies, leaving businesses that demonstrate consistent ability to generate value above their cost of capital. Now layer on growth. Filter for sales growth and profit growth exceeding 20% over that same 3-year period. Requiring both top-line and bottom-line growth ensures that a company's expansion is translating into actual earnings, suggesting the presence of operating leverage. Even a high-quality business can be a poor investment if the entry price is too high. To address this, we use the PEG, or price to earnings to growth ratio. You calculate this by dividing the PE ratio by the earnings growth rate. A stock with a PEG above 1 fails the valuation check, while a stock with a PEG below 1.0 passes, suggesting its growth is currently underpriced by the market. This intersection of high ROCE dual-line growth of a low PEG ratio identifies the rare compounder that hasn't been fully discovered by institutional investors. Next is step 3, the cash flow and solvency pillar. Add a rule for a debt-to-equity ratio of less than 0.5. Multibagger investing requires holding for 5 to 15 years. Over a decade or more, a company will inevitably have to navigate a recession or a tightening credit cycle. Companies with high leverage often struggle during these periods. Low-debt companies, by contrast, have the financial resilience to survive downturns, and often emerge stronger by acquiring weaker competitors. Step 4 focuses on the governance pillar. Filter for strong insider alignment by requiring promoter holding to be greater than 45. It is important to remember that passing this screen is not a signal to buy immediately. These results represent the starting point for your research, not the conclusion. Quantitative metrics tell you what has happened, but you must perform qualitative analysis of annual reports to understand the why behind those numbers. This is where you investigate the industry dynamics, the management's integrity, and structural sector tailwinds that could sustain growth for the next decade. I challenge you to run this 4-pillar screen today. Pick the top 3 companies from your results and read through their most recent investor presentations. Success in growth-oriented investing comes from applying a rigorous system that improves the probability of identifying resilient, high-growth businesses early in their trajectory.